We all know interest rates have gone up and rents have actually come up pretty quickly too. But let's face it, rental cash flows are still getting hit for landlords, especially if their tenants haven't changed recently. Now, fixed rates are looking pretty good these days, and so they do seem like an easy choice at first glance. But wait, you might also be aware that economists are predicting that fixed rates are going to come down by next year, and so you definitely want to take that into account when you're making your decision as well. And then there is more. There could be other factors playing into your decision making, especially if you're thinking about changing up your existing mortgage. And that's exactly what we're going to be breaking down for you in this video. And so if this is something on your mind, just stick around and keep watching. Okay, let's go back a bit. Before rate hikes, variable rates were definitely the more popular choice. They offered a sizable discount over fixed rates, even if you take into account expected future rates. Basically, payments were lower at the start as well, which meant people could qualify for bigger loans, and they were also more flexible if you needed to break an existing mortgage and refinance your property to grow. Even when rates started to go up, not many people expected them to rise as quickly or as much as they did, and so people were still choosing variable rates when interest rates were starting to rise. But now things have done a 180. Fixed rates are now lower than variable rates, and so if you wanted lower payments and you wanted to qualify for a bigger mortgage, then fixed rates are now the way to go. Currently, the best 3-year fixed rates are at around 4.8%, while variable rates are at 6%. Now, nobody knows for sure what rates will be next year or the year after, but if we go by the forecast by the big banks, it does look like rates might drop by 1.5% next year, and then around 2% from today a year after. And so if you take an average of these rates, it does come out to a pretty similar 4.8% average variable rate over the next 3 years, which is pretty much what fixed rates are these days. In other words, that discount that you normally get with variable mortgages just isn't around anymore, even though you are technically taking on higher risk. And you'll also be getting higher payments at the start with a variable mortgage. Sure, it's true that rates might drop more than the currently expected amount, which could make variable rates end up being better, but it's also just as possible that rates won't drop as much as expected, which could make variable rates look worse. So when you think about it, if you're getting a new mortgage, it might just be better at this point to stick to a 2 to 3 year fixed rate, since the expected current returns are the same, but you eliminate the uncertainty with variable mortgages. So basically, fixed rates make a better risk-adjusted choice. Now, as real estate investors, we do like to have our options and flexibility. And so if you do choose a longer 5-year fixed rate, it might actually limit your choices down the road if you wanted to refinance or expand your real estate portfolio. And so that's why we still prefer a shorter 2 to 3 year fixed term at this point. This way, in our opinion, you are balancing lower risk during the more uncertain times over the next few years with just more freedom in the later future. Now, if you do have an existing variable mortgage and you're thinking about switching out of it into a fixed rate mortgage, then you actually have a few more things to think about, and we're just going to be talking about it right now. The first thing is the penalty to break your mortgage, and this can very much vary from lender to lender. But most variable mortgages do charge 3 months of interest if you break it, and that could mean a big difference in terms of whether or not you should make the switch. So if you're paying 6% on your variable mortgage right now, that's a 1.5% penalty, which is pretty big, and that would mean making the switch isn't really worth it anymore. The good news is that if you do stick with your current lender, a lot of lenders might be able to treat it as porting your current mortgage, and that means you won't actually have to pay any penalties. Now, if that's the case for you, then this can change everything. At that point, from a net income perspective, it's actually the same story as getting a new mortgage. You do have similar expected interest rate expenses by making the switch, but you end up reducing your risk, which ends up making it a smart move to improve your risk-adjusted returns. But the last thing to remember is not to forget about cash flow. Now, even though making the switch from a fixed rate mortgage might yield better risk-adjusted returns, it could still negatively impact your cash flow if you're currently on a variable mortgage with interest-only payments because you've already hit your trigger rate and your principal payments have already been squashed. Now, let's say you do have an $800,000 mortgage with a 6% interest-only payment, which costs at this point around $3,900 per month. Now, if you do make the switch to a new 4.8% fixed rate mortgage, you will have to add back the principal pay down each month, which actually means that your monthly mortgage payment will increase to around $4,200. And that is obviously higher than before from an outgoing cash flow standpoint. So if cash flows are the most important thing for you, then sticking with your current variable mortgage might actually end up being better for you. Better holding power might actually translate to being more comfortable with you hanging onto your investments, which could end up being the more important factor for long-term real estate investing. Everyone's situation is unique, and so decisions you make about your mortgage should very well reflect that. Now, optimizing your real estate portfolio is crucial if you do want to grow your wealth through real estate investing, but that's also where we come in. We're a real estate sales brokerage based in Toronto, and our core focus is to help investors like you navigate the complex world of real estate investing in Toronto. And so, if you are interested in learning more about how we can help you, we're happy to chat with you privately to learn more about your situation, and you can book a time to speak with us directly in our calendar at the link right over here. If you enjoy this video, please give us a thumbs up and subscribe to our channel for more insights on real estate investing in Toronto. We cover everything from market trends to housing policy to interest rates and investment strategies. And our goal really is to make real estate investing as easy as possible for you, which is why we offer a range of services to support you throughout your entire real estate investing process, from planning and analysis to sales, renovations, leasing, and property management. And you can learn more about us by heading to our website over here or find us on social media. Thanks so much for watching, and we'll see you in the next one. Bye.